Okay. Hello, my dear future child accountants. Hope everybody is doing great. Can you please confirm first that my voice is audible and the PPT is visible? I hope all our sessions are being are useful. In the last week, we had a discussion on chapters about portfolio management, mutual funds, and we also kick-started with derivatives. I think futures have been done, options are yet to be touched. Let me address the questions I've received in Google form. So for sharp index, can we calculate unsystematic risk as balancing figure for unsystematic risk? We can do unsystematic risk as balancing figure as far as individual stock is concerned. For individual stock, we calculate systematic risk, and from the total risk, we subtract systematic risk. The balancing figure what we get is unsystematic risk. So for individual stock, we do calculate by balancing figure. For portfolio sharp index, it has to be individual components weighted average. For systematic risk, we say the beta of the portfolio multiplied by the weighted average portfolio of weighted average portfolio beta and multiplied by the standard deviation. But for unsystematic risk, we have to calculate the weighted average of individual stock. So stock A has unsystematic risk, stock B has unsystematic risk, stock C has unsystematic risk, and we take a weighted average by squaring it also, of course. That total risk is not done by, for a portfolio, unsystematic risk is not calculated by balancing figure. While calculating revised weights, why did you take 1 lakh as negative? Okay, this concept is regarding APT theory, arbitrage portfolio theory, where we try to mix the positions of long and short. In the problem given, what we have been discussing about, a person has invested 1 lakh. But what is the proportion which is invested? 1 lakh is invested in stock A and he is shorted in stock B minus 50,000. So when you short, we treat as a liability. So long is asset side, short is liability side. So long 1,50,000, short 50,000, net investment 1 lakh. And if you borrow additional 1 lakh, and do it in the same proportion, meaning again long 1,50,000, again short 50,000, so that 1 lakh will be invested. And since you're borrowing 1 lakh, we have taken that as negative. When you borrow 1 lakh, borrowing is a liability and therefore that is considered as negative weights. Why fixed income securities in mutual funds not taken at realizable value? Fixed income are usually held till maturity. So the market fluctuations usually will not be considered. So fixed income securities are usually considered at book value unless some information is given. What is explanation of net settlement basis? We have discussed in our the concept of derivatives. But anyway, let me quickly address the concept of net settlement versus the gross settlement or delivery basis. When I sign a contract to pay something to get delivery of goods or shares, I actually make a payment and getting the delivery of shares is called as settlement on delivery basis. Settlement on net basis means I don't make the payment, I don't get the shares, but I settle on net basis. Example, suppose I agreed for a price to buy at 1,000 rupees. This is the commitment I've made after 3 months, let's say. And after 3 months, the actual price is, let's say, 1,050 rupees. Now, whether the market price is 1,050 or 950, it does not matter. I have signed a contract, I pay 1,000 rupees, I get one share, that's settlement on delivery basis. On the other hand, I just receive because after buying 1,000 rupees share, I sell in the market, I make a profit of 50 rupees. So what do I tell? I will not pay 1,000 rupees, you don't give me the share. My net profit 50 rupees, you pay me. That's all I wanted. So this mode of settlement where the original delivery of shares at the original price will not take place. Instead, the difference between the prevailing market price and the agreed price, the differential amount is paid or received, and that's called as net settlement basis. What is random error? Unsystematic risk is called as random error. What is the meaning of borrowing in APT theory? Borrowing means borrowing. You take a loan and you invest, and the borrowing will be treated as negative weights for portfolio weights calculation. Difference between CAL and CML. Capital allocation line is when you invest in a particular security of a market. But if you invest in the best security, okay, this stock represents the market. If everybody is aware of the information, if the market is perfect, everybody will invest in this particular stock, which is, good for everybody in the market. That is capital market line. Indirectly, when you invest in a particular stock, that is capital allocation line. When you invest in the market itself, that's called as capital market line. In practical scenario, I can say you invest in index that represents market, and the proportion of investment between risk-free security and market, the return plotting on the graph becomes capital market line. What is CAGR? What is the meaning of more than 100% investment portfolio? How can I invest more than what I have? I borrow and I invest. So when I borrow money, I invest in stock market. My invest in stock market is risky, and my borrowing is also risky, because when I take borrowing, my debt is there, and whenever we have a debt, it represents risk. So I am taking more risk than market, and that is situation of investing more than 100% with the help of borrowing. What is the purpose of calculating levered and unlevered beta? The purpose is more relevant in the merger chapter, because if I want to value a company which takes loan, but I don't want to know their impact of loan. I don't want to have the value of the company when the loan is there. I want to know pure value of business. Okay, or maybe one more use case scenario. I'm acquiring a software company, which is a private company, unlisted company. Now, that software company has loan. Now, for valuing that software company, I go for Infosys. Because Infosys is also software company, I take those valuation multiples and apply it on this unlisted software company. But the problem is, Infosys does not have debt. Their risk is less. But this software company has debt. Their risk is more. So we have to adjust those risk elements. In that case, the levered beta, unlevered beta concept comes into picture. More about it when we do the merger chapter, you'll understand. What is CAGR? CAGR full form is compounded annual growth rate. That's the term used mostly in practical life, not in theory books. CAGR basically means on an average every year how much return I got. Nothing but compound interest. So if today price is 100, And if 100 is 10%, means it becomes 110. On 110, 10%, it becomes 121. So what is the growth on an average? 100 becoming 121. Every year is grown by 10%. That every year growth is called as CAGR. While calculating closing NAV, we calculated income, but we already calculate income for sub-question. Why don't we take the income as complete sub-question and sub-question 5? Okay. The income, what we calculated in the previous sub-questions in mutual funds would actually mean income earned. But what we have to calculate for closing NAV means income earned plus portfolio appreciation, not just income received, the portfolio appreciation and minus any dividend distributed. So net amount is what we should take it for NAV purpose. How do we use industry P ratio? Using P ratio is one of the ways in which market is valued practically. The shares are valued practically. There is no science behind share valuation. There is an art, and there is no one answer to it. Different people have different methods. One of the methods is P ratio. To give an example, Infosys might be trading at now 25 P ratio. Historically, we look at, let's say Infosys is trading at 30 PE. Now, what do we say? Historically, it was traded 30 P ratio. Now, it is at 25 P ratio. So, it is available at cheap. That is one way of looking at it. Or we say, oh, industry-wise, the software industry is at 28 times, but Infosys 25 times. As compared to the industry, the Infosys is underpriced. So, we should invest. Do we make profit? Nobody can guarantee, but one of the ways in which the best, simplest way in which you can assess whether a company is overpriced or underpriced is through P ratio. But it is not foolproof. A company like Bajaj Finance, company like Asian Paints are having 100 plus P ratio consistently for a longer period of time. So they are costlier. When a stock is trading at 100 plus PE, it is costly. But some stock remain costly forever and some stock do correct. Infosys, share price went to almost 1900 where the P ratio crossed 30. It became costlier. I sold. Then it became 1200. In P ratio became 20, less than 20. I purchased. So it works there. So in some case it works. Some case does not work. There is no one single way, but this is the way P ratio is used practically to apply whether a stock is underpriced or overpriced. Regarding November 2022 RTP, that I don't have it ready. So please share the photo of that in the Telegram group, in my Telegram group, Advait Learning FRSFM. I'll address your doubt relating to the RTP so that everybody else also will get benefit from it. So I have addressed all the doubts which I have received through Google form. If you have any other questions still, please go ahead. I will try to solve it. And regarding practical case scenarios, I am working on it. Let these classes get over. After that, maybe in from the month of March, I'll start sharing some practical related videos and live sessions also. If the response is good, I'll plan for live sessions as well. And I'm already asking for the suggestions. Many people have given suggestion. I do consider it. If you have anything, so please put a suggestion in the Telegram group, Advait Learning FRSFM. You can search for it. You can put your doubts. You can put your suggestion over there. I do consider it while preparing videos for practical applications. Okay, so I think no other questions are there. Maybe in the next week we can get more because derivative is going on. While calculating number of units to be issued for dividend reinvestment, we have taken NAV after deducting dividend amount from net assets. What is the reason? Because when you distribute the dividend, the NAV will fall down. It anyway comes as reinvestment that everybody may not do it. Some people may reinvest, some people may choose not to reinvest. So the transaction happens in two levels. First, the mutual fund will distribute the dividend. So dividend will be received by the investors and some investor will reinvest and some people may not. So we have to take it as separate two transactions. That is why NAV will be affected when you pay dividend, NAV will fall down. Okay. Uh, Very good. No other questions that I could see. Okay, very good, great. Thank you for your time. I hope you're making use of these sessions. If you get any further doubts, you can also post it in the Telegram group. I'll try to answer it. So till then, please enjoy the classes. Take care. See you. Bye-bye.